The constant question over whether the RBA is actually going to get involved over the next couple of years to increase cash rates has always been on the cards. Now we're getting word from Philip Lowe saying that,
you know what? House prices are not our problem and you guys need to back off.
So in this video, let's just discuss what they've actually said, what he's specifically said, and how this affects the real estate market in Australia and what we should do to prepare for this over the next couple of years. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because we talk about real estate, cryptocurrency, and financial freedom. Now, if you aren't following me on Instagram, please follow me on Instagram because I'm going to release a lot more information on there than I do on my YouTube videos because as you can tell, it takes time to shoot these videos, and now with work getting absolutely crazy, so many people wanting to come on to the buyer's agency, strategy sessions getting booked out, I want you guys to stay up to date. So follow me on Instagram, and if you want more in-depth and detailed information on the daily, then definitely join Patreon. There's links in the description below for both of those. Now, what we're gonna see here is Philip Lowe coming out and he's just spoken about why he thinks that the RBA is not in control of house prices. That's not our problem. We're looking at inflation, and inflation based on our numbers, not your numbers or the real numbers. So let's just go through this. It's an article on Yahoo Finance, and I think it's really important to start deconstructing our thoughts around why we think cash rate, will increase and interest rates will increase, and what that means for us as home buyers. Absurd house prices are not our problem, says RBA. The Reserve Bank of Australia, the RBA, will not lift the cash rate to cool surging house prices, Philip Lowe said. Lowe said raising the cash rate, currently sitting at a record low of 0.1%, is not on the agenda for the bank, despite admitting it would help ease prices. So the fact that they know this and they still don't want to do it, it just begs the question to be asked, what's actually going on here? While it is true that high interest rates would, all else equal, see lower housing prices, they would also mean fewer jobs, lower wage growth. This is the poor trade-off in the current circumstances. Now, this is what I've been talking about on my channel over the last couple of weeks and months, and I'm saying, look, it's not just as simple as, oh, house prices increase, so let's just increase our interest rates so the house prices come back down. Who are the winners and losers in this? And, at the end of the day, with or without me, the prices are gonna go up just in line with their cycles. And the thing is, we need to look at when we assess interest rates and cash rates and, oh my God, should I buy property or not because interest rates are gonna go up all of a sudden, despite what Ravi says, is that we need to figure out why are interest rates even in place. And that's because we need to have that regulate, or at least start regulating, the economic activity that happens in our system. Now, we're coming off the back of 2 years where Australia wasn't normal. We still have lockdowns this year. We're still currently in lockdowns. We're in September at the moment. I'm not sure when you're watching this, but in Sydney and Melbourne, we're still in lockdown. So when your biggest economies in Australia are still in lockdown and we're not performing at optimal level, well, why would you increase interest rates just so that we can calm down housing prices? They've got bigger fish to fry, and at the moment, they do not care about housing affordability, and I don't think that's changing anytime soon. Instead, Lowe pointed to a number of public policy issues which are the responsibility of the government that need to be addressed if we want house prices to calm. While monetary policy is contributing to higher house prices at the moment, the way to address these concerns is through structural factors that influence the value of land upon the dwellings that are built, Lowe said. The factors include the design of our taxation and social security systems, planning and zoning restrictions, and the type of dwellings that are being built, and the nature of our transportation networks. These are all obviously areas outside of the domain of the monetary policy and the central bank. Though Lowe falls short of directly criticizing the federal government in this regard, dozens of property economists and experts have voiced that the lack of cohesive policy around housing has resulted in a triple crisis. Now, I have made videos on this channel before around the crisis, the housing crisis that we're facing. So if you are interested, go check out that video straight after this. So in the simplest way to understand this is that if the interest rates actually go up, all these businesses that have taken on debt, during the COVID pandemic and lockdowns, they've gone out and taken debt to stay afloat. Now, if they stay afloat, then people they employ also stay afloat, right? So they're allowing the businesses to stay running so they can hire people and they still have a job. And in fact, those people who have a job may be renting or they have houses themselves and mortgages. So the whole economy keeps moving. However, if you start slowing down credit, so in this terms, like looking at monetary policy, your cash rate, and increasing that, what it does is that it means you're increasing the cost of borrowing, which for a lot of Australians is the biggest cost they have, is their home loan, right? So if you increase that, suddenly you have less money to go out and, buy goods and go to cafes and restaurants to buy things. Now, if that means less you're spending, the restaurant makes a lot less as well. So if they're making a lot less, why do they need to have 5 staff? They could just have 4 staff, so they get rid of 1 person. Now you've got increase in unemployment. So you can see it's not just as easy as going, oh, well, housing's going up, let's increase interest rates. Oh, housing's going down, decrease interest rates. It's not as simple as that. And I just want to give you some clarification and some context as to why they are saying particular things. Wages won't be rising anytime soon. Another major economic issue outlined by Lowe was that of stagnant wage growth, which is impacting Australians for years. Lowe said wages need to be increasing at least 3% before the bank considers raising interest rates, a target that we remain well short of. Even in industries where there has been strong demand for labour, wage increases remain mostly modest, he said. Our judgment is that it will take some time for wage increases to lift to a rate that is consistent with achieving inflation targets. Now again, what they are using for inflation is completely warped. They don't use housing as an indicator of what's happening. So if we on one hand see that wages aren't growing and we see inflation is in the system, right? You can go to the grocery store and things are costing a lot more than they did say 5 years ago compared to now. This is happening. Inflation is here. Now we're also seeing house prices take on, 20, 30% growth in a year, yet our wages are the same. Now previously what we would do is use that money, put it into the bank, and now we're earning interest. So our money's working for us and we're growing. So at least we're going, you know what, if our wages don't grow, at least the money I have in the bank account is growing. Well, now that doesn't happen either. So now not only are people that are saving their money losing, they're not just losing out on extra savings, they're actually falling behind the whole system because groceries are getting expensive, but also your most basic need, which is housing, is becoming more and more unaffordable. A number of factors are to blame for low wages, Lowe added, indicating the long road ahead before we see a lift. There is a lot of inertia in the wage setting process, and the experience of the past decade is unlikely to be reversed quickly. When will rates rise? Not until at least 2024, Lowe said. In fact, he dismissed the estimates made by some of the big 4 banks that rates could rise as soon as next year. I find it difficult to understand why rate rises are being priced in next year or in early 2023. It actually blows my mind too. We finally agree, Philip. So if you're watching this, peace. My understanding is that we are in a whole debt-based system. If we suddenly start having increases in cash rates, and it blows my mind that after so many videos that there are still people that email me going,
But Ravi, why would I invest? Interest rates are going up next year, right? Because CBA said, and NAB said, and ANZ said.
Mate, there are more banks than the big 4 banks, right? They are the big 4 because market cap and whatnot, but I don't think they think like the big 4. So if you are from the big 4 bank and you are watching this, definitely reach out. I'd love to have a conversation with you, but I'm not really sure what they're thinking going, well, we've got debt, but now we're going to increase interest rates because we think the economy is going to recover. And so we need to keep on top of this. It seems like it's more just a profit taking scheme where they've like,
hey, you know what? People love to stay with us, the big 4 banks. Most Australians are stupid. So you know what? We'll increase our interest rates just slightly. People will get a little scared. They'll start fixing their loans. And you know what? Even if we enter negative interest rate territory or they decrease or they stay the same, we've locked in profits for the next couple of years.
That's essentially what's happening. Even Philip Lowe from the RBA is coming out and going, dude, what are you guys thinking? While policy rates might be increased in other countries over the time frame, the wage and inflation expectation experience in Australia is quite different to these in other countries. What's happening elsewhere in the world doesn't apply directly here. Lowe said until the unemployment rate lowers and wages are boosted to at least 3% and home prices come back under control, the bank has no plans to increase the cash rate. At the end of the day, how are house prices going to come under control when the cost of borrowing is so easy and so cheap? I'm not sure how that's going to happen. In today's low inflation world, how are we in low inflation, bruh? We do not want to run the risk that we increase the cash rate on the basis of forecasts that ultimately does not come to pass, having inflation stuck between the target band. We want to see actual results, not forecasted results, before we lift the cash rate. Once we can see these results, forecasts of inflation will again have to play a role, but we have to get there first. Lowe said the bank wants to see inflation around the middle of the range, and he said has reasonable confidence it will not fall below 2 to 3% range again. Our judgment is that the condition for a lift in the cash rate will not be met before 2024. Look, I know that you can only take these, with a grain of salt. You can't take this to the bank. I'm not sure what bank you're going to take it to anyway. But essentially, what they say and what they do could be completely different. We know that. There is a huge disconnect in the economy, what the real economy is and what, is actually happening and what they're saying is the artificial economy. And so what I want you to take from this video is a prompt to just go and take a step back and understand what's at play. If the banks, the big 4 banks are increasing the interest rates, but then there are other financial institutions that aren't doing doing so? Well, you've got to now question, are these guys acting like the boomers, the traditionalist sort of businesses? Whereas the new age businesses, the digital businesses and neobanks, are they onto it more? Are we going to see a shift between people moving loans from the big four traditional banks into more of the smaller institutions, the second tier banking? I think so. I think it's happened in every other industry. We've seen business in any industry. When they start becoming complacent or they start going, hey, we want more profit, and it's not in line with what in reality is happening, they start losing market share. So that I think is a big problem. Two, there is no loyalty in the system. So people aren't afraid now to move loans around. People are a lot more astute in terms of education around the space of, hey, I need to go see a broker. I need to, shop around for my interest rates. And then there's channels like this, where you can get educated as well. So if you have enjoyed this video so far, drop a like for the YouTube algorithm so we can share these videos out to more people. But I hope you've enjoyed this video. I want you to just calm down. When you start seeing interest rates increase and they're like by 0.1%, you're like,
oh my God, I can't buy property because it's all coming crashing down.
Take a step back, put it into context. If you're getting a loan for $1 million, what's an increase of 0.1% when the property itself is going up by 10%? This isn't gonna last forever. I know that people might not have watched all the way through and they're probably going into the comment section and saying,
oh, he's thinking property's gonna go up forever.
Clearly that's not the case. I don't try and hype things up. I tell you guys how it is, and I'm fairly transparent around what I do and why I'm preparing for what's happening next. Thank you so much for your time, and thank you so much for watching. If you're new here, subscribe and watch a couple more videos. I'll catch you guys in the next one. Thanks, guys.